This is the AI News Flash for April 27th, 10 a.m. UTC. First up, China has officially blocked Meta Platforms' $2 billion acquisition of Chinese AI startup Manus. Bloomberg, Reuters, Financial Times, Washington Post, and the New York Times all reported simultaneously this morning. China's National Development and Reform Commission rejected the foreign acquisition of a strategic AI company on national security grounds, ordering the deal to be unwound. Manus is a Shenzhen-based startup that has rapidly grown in autonomous AI agent development, and Meta announced the acquisition last December as part of its Superintelligence Labs expansion. Following earlier exit bans on co-founders, this formal block marks a decisive turning point in the US-China AI tech Cold War. Beijing has clearly prioritized protecting its domestic AI ecosystem and foreign investment in AI businesses at Tencent, Alibaba, and ByteDance is expected to face stricter scrutiny. This sets a precedent forcing Silicon Valley to rethink its entire China AI talent acquisition strategy. Second story, South Korea's KOSPI index closed at a record high of 6,615 today, driven by an AI semiconductor-led tech rally. According to UPI, Samsung Electronics and SK Hynix surged on the back of fully sold-out long-term HBM memory supply contracts, lifting the broader index. Year-to-date gains exceed 40%, significantly outperforming the U.S. Nasdaq. NVIDIA's HBM4 supply deal for Vera Rubin, multi-billion-dollar memory procurement agreements with Meta, and Micron's sold-out 2026 HBM capacity all concentrate the benefits of over $650 billion in AI infrastructure spending toward Korean memory leaders. Net foreign fund inflows into Korean stocks hit a record 6-month high, and the market is reevaluating Korea's position alongside Taiwan's TSMC as a core node in the Asian AI supply chain. The AI memory supercycle is expected to continue at least through 2027. Third story. The Wall Street Journal published a detailed analysis today showing that big tech's $650 billion AI capex spree is the direct cause of mass workforce reductions. Meta is implementing additional layoffs of 16,000 employees, Amazon is cutting 14,000, and Microsoft is reducing 15,000. CFOs across companies cite the need to offset AI infrastructure costs through headcount reduction, making the contradiction of massive investment alongside massive layoffs unmistakable. The WSJ notes that AI capex is now consuming 70 to 100% of operating cash flow, more than double the 10-year average of 40%. Both the uncertainty of return on investment and the structural impact on labor markets are simultaneously concerning. Multiple CFOs have stated they will continue AI investment even with 30% headcount cuts, signaling a fundamental restructuring of white-collar employment. Enterprise AI monetization will be the next critical test. Fourth story, a research finding published on Eureka Alert today shows that an AI tool can detect attention deficit hyperactivity disorder, ADHD, in children years before formal clinical diagnosis. The research team used machine learning to analyze behavioral data, academic records, sleep patterns, and biometric signals, successfully predicting ADHD risk with high accuracy on average 2.5 years before traditional clinical diagnosis. The sample size was several thousand children, with sensitivity exceeding 75% and specificity above 80%. Early intervention could significantly reduce risks of academic difficulty, low self-esteem, and secondary disorders, marking an innovative breakthrough in pediatric psychiatry. Over 5 million children in the U.S. alone have ADHD, and diagnostic delays have been a persistent social challenge. However, concerns over privacy, labeling, and overdiagnosis from AI-based mental health prediction were also raised, directly tying into the AMA's congressional request last week for stricter mental health AI regulation. Clinical adoption requires an ethical framework as a prerequisite. That's all for this AI News Flash.